Hello and welcome to the Weekend Investing Stock Market Weekly Review for the week ended 14th of February. We were hoping that the Valentine week will bring some love to the market, but completely opposite of that happened and the market got thrashed badly this week. Uh, this week from our research desk, we had all these fantastic content pieces um, about Sensex struggles, basis some resistance levels, how long is this money printing and the debt rising going to sustain, no rewards without risk, following trends, BBC principle, retail guys getting too optimistic, and obviously this week they have been smashed down. Opportunity cost, how long we can wait before the opportunity cost comes into the picture. How big a problems are US tariffs? Gold and equity ratio, we'll discuss that. Uh, Power of narratives and the problem of concentration. This and more on the Weekend Investing Research Desk. You can watch this on the blog. You can read it in the daily newsletter. And many of these are also available in the video format on the Weekend Investing app. Do read the disclaimer fully. There is no intention of disclosing any returns or any you're prospecting for any new products or subscriptions. This is purely for relaying what happened this week. Do subscribe to the channel if you haven't. Nifty this week 2.68%. So Nifty not really showcasing what happened in the broader market. So 2.68%, while it is a good cut, it doesn't really show you that internal picture of what was happening. Nifty has now bounced once again for the third time from this level of 22,775 odd. This is currently where the support lies. The chart is probably as bad as it gets, though we are getting oversold. We are in the fifth month of a continuous fall. This doesn't happen usually, and that would mean that the probability of having at least a bounce month, whether it is this month or the next, is very very high. So this may be, the last uh, sort of few days of massive correction that is happening before the tables turn. It may not be a U-turn in terms of the velocity of the turn or the calling out the bottom as such, but some sense of oversold and desperateness of the market folks is visible, and that usually is a sign that some intermediate bottom, if not the final bottom, is near. S&P 500 is doing very well. This is up. The markets there are up 1.48%. We are hitting a new all-time high on the weekly basis. So there is no reason for most FIIs to turn anywhere else, but rather stay in the US market with the dollar getting stronger and the markets also getting stronger. Gold is up almost 1.5% this week. This is becoming like you a no brainer, where everybody seems to be guessing that you just go to the market and you buy gold and it goes up. This too will see some correction soon. I think it is getting into some overheated zone, but a fantastic 8 weeks nevertheless on gold. On Indian rupee terms, it has gone from nearly 75,500 to 86,200, which is a fantastic gain in 2 months. Dollar index is the joker in the pack. It is now falling, having gone to 110. It is now reversing down and has broken down below this breakout point of 107. This is my sort of the only hope that I have, that which will lead to some maybe drop in FII selling, and perhaps the dollar rupee will also stop slipping the way it has been slipping. Benchmark indices. So 1 week has seen Nifty Small Cap 250 index go down by 10% this week itself. Huge cut, 7.5% on mid cap, 6.2% on Nifty Next 50. I mean, these are large caps. Nifty 500 overall dropping 4.6%, and Nifty dropping 2.68%. Over the last 1 month, the picture is no better, but Nifty has stagnated near this region. Over the last 3 months, Nifty again has not gone down, but small caps are down 13.5%. Over 6 months, Nifty is down 5%, and Nifty Next 50 is even worse off than small caps at 15%. And the last 1 year is still green for most, but for small caps, that has turned red. The uh, 3 year and 5 year, of course, remain reasonably sound. What needs to be noticed is that 3 year returns on Nifty is now below the long term historical average. So that would clearly mean that on the Nifty, there may not be as much pressure left going forward. That's the sense one is getting. Within the Nifty sectors, you can see capital market segment has taken the most of the brunt at minus 9.6%, real estate at minus 9.4%, defense, media, central public sector enterprise, energy, tourism, oil and gas, autos, all dropping 6% or more, and the rest are also between 1 and 6%. There was no gaining sector this week. In the last month gone by, we've had private banking, financial services. These sectors are at least flattening out and not dropping any further. If I see over 3 months, also financial services and private banks are in the lead. So there is a relative strength that one can see within the banking space and the financial services space, whereas public sector enterprise, real estate, energy, defense, capital market are all losing big ground. On a 1 year basis now, you can still see capital market, defense, financial services are still in the green, whereas energy, oil and gas, PSU, etc., are quite deep in red already. If we look at the sectoral momentum overview over 1 week, 1 month, 3 months, 6 months, and 1 year, you can see again the financial services, private banks, services sector, banking. These are the top sectors along with IT, which have maintained their momentum across the year. Whereas you can see energy, public sector enterprise, real estate, oil, gas, defense, these are all losing big time in terms of loss of momentum. If we see the trends, number of stocks above 200 DMA is 22 stocks, 22% stocks of CNX 500. So about 100 stocks, 110 stocks are still above 200 DMA out of 500, which is not much. And only 9% stocks are above the 50-day moving average on CNX 500, which is very, very low and shows you the kind of oversold and weak position of the market right now. In the benchmark indices, you can see uh, very few, less than 30%, in most cases 20% stocks are left above 200 DMA. This is very, very weak in terms of 80% or approximately 70 to 80% stocks are below 200 DMA. So that is really a very, very deep breadth of the market in terms of weakness. If we look at 50-day moving average, almost 80 to 90% stocks, even 94% stocks are below that 50-day moving average. So there is no momentum right now in terms of upward trend, and many strategies are henceforth getting into cash or rotating into more defensive stocks. If we see the stocks above 200 DMA, again, you'll be able to see still some stocks in IT, private banks, pharma, financial services are ruling above 200 DMA. There are several sectors where this uh, no stock is there above the 200 DMA. If I were to sort of look at the 50-day moving average, right here we are seeing many sectors where no stock is above 50-day moving average, and very few which have more than 25% or around 20%, which also is very, very less. So across the board, the entire market has taken a huge beating. There's not much of optimism as is there right now. If we see the metrics of golden cross, 34% stocks out of 500 stocks are at a golden cross with absolute strength uh, only in 3% of the stock. So absolute strength being 25-day moving average, more than 50, more than 200, only 13 such stocks out of 500 are satisfying this condition. Whereas on the reverse side, when the way we look at absolute weakness, 282 or 56% stocks are showing extreme weakness or absolute weakness. So this is a very clear showcase of the weakness in the market. The FI DII stats have not changed. They are selling almost 4 to 5 thousand crores every day. The DII stats are uh, similar to what FIIs were buying, but off late DIIs are buying less than what FIIs are selling, and you can see this very clearly in this monthly tabulation that 72,000 crores was bought versus 82,000 crores sold. So net 10,000 crores got net sold, which was not the case for many months in the past, where the both were very much equal. So this is where we stand right now. The markets are extremely weak. uh, this does happen once in a while. The markets will do their thing. The fact that we've had some great years and now we are having a bad year is, if you compare it to COVID times or 2018 or 2008, many of the indices are still not down anywhere close to what we have seen in the history. So from that point of view, it may be a further ride down if we have to go to those levels. But I think on a stock level, the breadth of the market has broken down almost similar to what used to be the case, and perhaps can happen more as well. So we really need to tighten our belts. We really need to have confidence that our strategy will see us through whenever the tides will turn and we will regain all the lost ground quickly.